Ladies and gentlemen, good evening. This is Christopher Aaron. It is the 13th of December, 2017. Do thank you for tuning in tonight. There was a Federal Reserve interest rate hike today. We are going to see how that impacted the precious metals. Gold was positive for the day, but let's look at a whole bunch of other asset classes and put that into perspective. As we look at the prices of the metals here, and gold finishing higher for the day, the Fed meeting was right here. You can see the line right here for 2 o'clock. This is where the Fed meeting was, and we see gold shooting up higher on the interest rate hike. And at this moment, I also wanted to mention that there is a coupon code right below this video for $10 off your first purchase at bullionexchanges.com. It's a dealership that I know personally. I know the owners. And by all means, if you buy gold from a dealership that you already trust, that's fine. If you'd like to try them out and to save $10, the coupon code is below this video. I just wanted to say I think it's important to buy from someone who you trust and who offers good prices, and these guys do that. We look at gold, we see the strength here coming into gold. We look at silver having an even nicer pop, clearly exceeding the previous price range, and we were talking about the potential for a low to come here into the price of silver in this range, looking for the support to come in around 1570. It looks very nicely like this has happened. Of course, seeing a few brief spikes below that, but this would be an absolutely fantastic low for this to form right here in the price of silver. Let's put this in perspective, some of the broad asset classes that we follow. And by the way, these are the asset classes that I believe if you are a precious metals investor, you have to be looking at these pretty much every week. So that's the reason why we follow these in the premium service. We include graphs and charts of these every single week, and we put that in perspective, the 2-year perspective every week. Because these, when we're talking about investing in precious metals, they share some similarity with other safety assets such as U.S. bonds. We can see here gold and U.S. bonds being fairly tightly correlated today as safety assets. Other times, gold is more correlated with commodities. So I think it's important to follow which way is gold acting. Is it acting as a safety asset or a commodity type of asset? So we can see gold finishing positive for the day, just under 1%. But the gold miners really outperforming, up almost 3.5% today on the GDX. And we had some gold and silver miners today, some individual ones that were up 9, 10, 11% in one day alone. So anyone who's been buying into these recent lows, like I've been recommending, this was a really positive day to see that in the gold miners. Of course, they've been really beaten up over the last several weeks. So we see gold and the gold miners coming out on top for the day. And I would just say, look at what has come in the worst today. 2 o'clock was the interest rate hike. The US dollar finishing the lowest out of these 6 major international asset classes. Yet the mainstream media, if you read what the mainstream media says, they consistently say that the US dollar stands to benefit from rising interest rates and precious metals should fall. Why? Because if you increased interest rates, this is the theory, you increase interest rates and the dollar should benefit as you will receive more in interest for holding your dollars, right? And therefore the Fed, by raising interest rates, should diminish appeal for the precious metals. And once again, I just say, if that is the truth, if rising interest rates, we could see 2 o'clock here, if they are negative for precious metals, please continue to raise those interest rates. So you really have to think here when you see price action like this compared to what the mainstream media will tell you. It's very dangerous to just read the mainstream news. So that's why we publish the research that we do here. It's to have an independent perspective on what's actually happening here. Looking at the Fed, the Federal Reserve, the central bank here in the United States, let's look at the history. A lot of people are thinking, wow, okay, they've been raising rates for the last couple of years. You know, we're in a new cycle of higher interest rates now. Really? Are we? I don't know. Rates here are still the lowest that we've seen in over 2 generations. And furthermore, I have gone back and done research. Now, this is the graph published by the Fed itself. The Federal Reserve, they only published, don't ask me why, through 1959. We can see here the lowest rates still on par since that time. But I've gone back and I've done research by reading newspapers and articles back from the Great Depression and World War II. And I will tell you that interest rates are still lower right now than they were during the Great Depression, where rates were brought down to 2%, and during World War II when they were brought down to 1.5%. So we're still equal to or lower than both of those periods. They've been held lower. And of course, remember, if you're thinking, okay, so what? They just lower interest rates, you know, they press that lever because they need to. They need to lower interest rates. No, that is not how interest rates work. In order to keep interest rates, which is the price of money, that's the way to think about it, the price of borrowing money in a short-term loan, in order to force the price lower, they have to buy the inverse of that, which is the yield curve. So they have to buy short-term bonds to force the interest rate lower. And how do they get the money to buy those bonds? They print it out of thin air, or they type the numbers into a computer and hit enter. And then they have that new magical money with which to buy bonds and with which to force down interest rates. So it's no coincidence that we've seen these bubbles popping up in various asset classes, from real estate to the stock market over the last 9 years. Why? Because they've printed all this money and basically given it to the banks through this process of keeping interest rates down. So the big point to remember here is if you think that low interest rates are the only way that gold can thrive, I would remind you that the single most powerful bull market that we've ever seen in gold prices occurred during this period, from the late 60s through 1980. Gold broke the dollar standard. It was not Nixon who broke the dollar standard. It was gold that did so. Gold forced Nixon to close the link between the dollar and gold. How did it do that? A lot of people don't pay attention to the time period in history here in the early to mid 60s, but gold actually began to rise before Nixon allowed it to. It began to rise in the international market, and it forced Nixon to sever the link. And so gold had its strongest rise from $35 an ounce through $850, a 2,400% gain in these 15 years plus or minus that interest rates were rising. So you think from this low, after falling for 36 years, are we entering now a new cycle of rising interest rates for perhaps the next 36 years? This very well could be. You look at these generational swings in interest rates and you look at where gold has really performed the best. It's in a rising interest rate environment, not a falling interest rate environment, as the mainstream media would tell you. Let's just look at the last 5 hikes here. The first 5 hikes since the absolute low here in December 2015. The first hike right here, the second hike right here, and I would say look at these lows forming here in December 2015, December 2016. The third hike, look at these lows. It's just amazing. People believe this myth. It seems that rising interest rates are bad for precious metals, and therefore they sell metals into the hike, and then gold rebounds right after the hike. The one exception here was this fourth hike. Gold fell for several more weeks before rebounding. And here we have the fifth hike coming in at what looks like a very important price low in this region for gold. You look at the December lows forming here, 1, 2, looks like 3 in a row. And I'll just tell you, everything looks like all systems go right now for the precious metals. You've had a ton of people lose interest here in really what is a fairly insignificant drop in the grand scheme of things. There's been a ton of negative sentiment building here in this last drop. We know where this comes in from the technical standpoint. Premium subscribers receive all the charts every week, but we are looking for a very important low to form here in December, once again matching with these lows that are forming within a few days or a couple weeks of these rate hikes. This being the first rate hike, by the way, not to feature a new high, a new price high. This rate hike by the close of the market today came in a few dollars less than the last hike, so we'll have to keep an eye out for that. Thank you very much for watching. The premium research does cover the exact mining companies that we invest in here, all the reasons why. Some of them have gotten really beat up. I think it's a great time to be formulating your plan for making final purchases. We also cover physical gold and silver, by the way, and we cover all of these broad asset classes that we looked at earlier. I work with individuals as well on a one-to-one basis, by voice and by Skype and by email. And I simply look out for the best interest of subscribers. I work with investors across the board, from new stackers to those investing several $1 million in the space, and we formulate strategies together from someone who would equally tell you to sell if I thought the metals were topping. I do not think they're topping. I think we are forming an incredibly important low at this time. It looks like all systems go. Let's watch this December low form once again.